Reverse Mortgage Daily reports that AARP has joined a class action lawsuit against former reverse mortgage lender, Reverse Mortgage Funding, or RMF, and loan servicer Celink. Now, the plaintiffs allege that Celink, under the direction of RMF at that time, added additional fees, costs, and penalties to HECM loans which are serviced by RMF and then subserviced by Celink. The suit alleges that these fees violate federal and state laws and consumer protections. In a press release, AARP stated, after RMF acquired their loan and hired Celink, both allegedly added unlawful fees for appraisals, inspections, property preservation, and attorney's fees or costs. Plaintiffs also seek to remove the unlawful and inflated fees, interest, and insurance charges from the loan balances of borrowers whose loans were being serviced by RMF or Celink. The lawsuit remains ongoing. The suit was filed in the Eastern District Court of New York on October 14, 2022 by the law firms Tusa PC, Giscan, Solotaroff, and Anderson LLP on behalf of the plaintiff, Sheila Dancy Wilkins, and her 93-year-old mother, Flora Mayweathers. That was on behalf of a nationwide class, thus the class action. In mid-November, the defendants filed for a motion with the court for an extension to answer or to respond to the complaint, which in fact was granted. A status update from both the plaintiffs and defendants is due on December 14th. Shortly after the suit was filed in October 2022, RMF's bankruptcy plan administrator notified the court that they do not plan to appear on behalf of RMF or to file any pleadings in the suit. Importantly, the plaintiff has agreed that any claims arising from this action will be treated as general unsecured claims against the estate of RMF, said the letter on behalf of the plan administrator. Now, does this mean that the plaintiffs would be unable to collect any damages should they win the suit? Not necessarily. In a letter from the plaintiff's attorney, Joseph Tusa, he states, in RMF's bankruptcy proceedings, RMF filed schedules representing that the plaintiff's class action claims in this area are covered by its insurance policies. Those insurance policies provide potentially tens of millions of dollars of insurance coverage to satisfy any default judgment entered against RMF. We'll keep you apprised of any developments in this case in future episodes. When it comes to making housing market predictions, the quote of Herb Brody comes to mind. He said, telling the future by looking at the past assumes that conditions remain constant. This is like driving a car by looking in the rearview mirror. True enough, I've made my share of failed predictions, and so have other professionals. But this housing market is quite unlike any other that has preceded it. Yet real estate data aggregators Redfin and Zillow have just released their forecast for 2024. Both foresee some improvements in housing inventory and prices next year, albeit moderate changes. And both also predict that mortgage rates will remain elevated. Money.com reports that Redfin and Zillow expect both price and inventory trends will reverse next year. Now, potential home sellers will, quote, grow weary of waiting for the historically low rates of 2021 to return, Zillow predicts, and that would lead to more listings. Now, at the same time, the increase in the supply of housing inventory could stoke more competition between sellers and help to send home prices back down to the benefit of buyers. But they will not be back down to 2019 prices. Now, while many on Wall Street are anticipating that the Federal Reserve will aggressively cut rates next year, last week's CPI report may have thrown some water on that notion. Inflation, as measured by the Consumer Price Index, or CPI, rose 0.1% in November, and that was more than expected. Consequently, mortgage rates are expected to fall just modestly, but remain high throughout the year. And Redfin also predicts that rates will only drop to about 6% in 2024 at best, down from their current rate of over 7%. Realtor.com recently predicted that mortgage rates in 2024 will average 6.8% for the year and reach 6.5% by the end of 2024. So while this does provide us a macro forecast of overall home sales and mortgage rates for the traditional market, what about reverse mortgages, or more specifically, the home equity conversion mortgage? In its recent blog post entitled Higher for Even Longer, Swiss RE senior economist Mahir Rashid writes, "The sharp sell-off in U.S. 10-year Treasury bonds this autumn has primarily reflected markets coalescing around expectations of higher natural long-term policy rates, greater inflation volatility, and a shrinking Fed balance sheet. We see these trends maturing further and now see 10-year U.S. Treasury yields averaging 4.2% over the long term, 40 basis points above our previous forecasts." And he also adds, since future policy rates reflect inflation and growth expectations, this may reflect an emerging belief on behalf of the Fed that inflation will be more volatile in the years ahead. Another factor that could keep rates elevated is a retreat in foreign demand for U.S. Treasuries, otherwise known as U.S. debt. Swiss RE notes that China now holds $805 billion of U.S. Treasuries, its lowest share since mid-2009, while Japan's share of Treasury holdings is down by $210 billion from a peak of $1.3 trillion in November 2021. On October 25th, the 10-year constant maturity Treasury rate was 4.95%, when combined with a HECM lender's margin that pushed many into an effective rate that was just below 8%. However, since that peak, we have seen the index fall consistently, and it's now hovering near 4.25%, a 70 basis point reduction. Ginnie Mae released its 2023 annual report this week, and it touted its additional support for the Federal Housing Administration's Home Equity Conversion Mortgage Program and its own HECM-Backed Securities, or HMBS, program as an accomplishment. In the report's executive summary, the company touts additional quote-unquote enhancements to the HMBS program among its accomplishments, and those include certain changes that were applied this year to the HMBS program, as well as the assumption of reverse mortgage funding, or RMF's servicing portfolio. The unpaid principal balance of HMBS did not grow during the fiscal year 2023, remaining at slightly more than $59 billion, and that represents support for nearly 287,000 senior households, and it reflects a 5% decrease in households from the fiscal year 2022, the report explained. Demand in the structured market for HMBSs remained consistent, with a slight increase despite the changing macroeconomic conditions. Although HECM activities increased in the fourth quarter of fiscal year 2023, with August application and endorsement counts above the 12-month rolling averages, in fiscal year 2023, HMBS issue volumes declined in reaction to accelerating interest rates, said the report, largely in alignment with observations made by FHA in its own annual report released last month. Ginnie Mae's report also addresses the takeover of reverse mortgage funding, or RMF's HECM Mortgage-Backed Secuities, or HMBS, portfolio. Upon seizure of the defaulted portfolio, Ginnie Mae assumed all obligations to the HMBS investors and all servicing responsibilities, stepping into the role of issuer, the report found. At the fiscal year end, Ginnie Mae's balance sheet increased by over 50%, primarily as a result of the RMF default. RMF marked the first time that Ginnie Mae had extinguished an issuer from the HMBS program. As a result, the assumption of the portfolio and the act of stepping in as an issuer made for the first time that Ginnie Mae was required to onboard a substantial portfolio of HECM loans and corresponding HMBS obligations. Liquidity pressures in this space also pushed Ginnie Mae to adopt new HMBS-specific policies for its program. The company reduced the pool sizes to provide relief to smaller HMBS issuers to securitize multiple tail participations, which will go into effect during the first quarter of fiscal year 2024. Ginnie Mae explained that while the discount rate for the reverse mortgages did increase, this was undercut by the heightened interest rate environment in its managerial assessment. Thank you for joining us for another episode of HECM World Weekly. In our video edition, we also have an audio edition, which you can find on Apple Music and Spotify, and of course, here at HECMWorld.com. We look forward to having you come back next week for more reverse mortgage news and commentary you can only get here at HECM World. Have a great week.